Good morning. My name's Sarah Williamson. I am the CEO of FCLT Global. We are a nonprofit organization originally known as Focusing Capital on the Long Term, whose mission is to rebalance capital markets to support a long-term sustainable economy. Our members are leading asset owners, asset managers, and companies from around the world. And many significant asset owners, asset managers, and companies are in this call today. We'd welcome leading organizations who are committed to cutting-edge thinking to join us. Our members participate in calls like this one, collaborate on our research, and engage in problem solving on the most critical issues in capital markets today. You can find more information on our website or reach out to us directly. So thank you for joining us today for this webinar focused on investing for resilience, the future of capital flows in the Asia-Pac region. Our panelists will discuss how to invest, and to build resilience following this current crisis and the impact of capital flows in the Asia-Pac region. We'll concentrate the discussion around the following themes: driving a low-carbon economy, recapitalizing the economy, investment opportunities, and building trust and leadership for the future. So we're excited to welcome you to this important discussion and look forward to insights from our guests. Quick housekeeping, we have a 60-minute discussion. We'll hear from our panelists for 35 to 40 minutes and then turn to audience questions. We received a number of pre-submitted questions, and you may also submit a question during the webinar using the Q&A function, or you can email my colleague, Sarah Simons, SARA.SIMONDS @fcltglobal.org. So let me introduce today's guests. Soo-Yi Kim is Senior Managing Director and Head of Asia for CPP Investments. CPP Investments is a professional long-term investment management organization that invests around the world in the best interests of more than 20 million contributors and beneficiaries of the Canada Pension Plan. Chow Kat Lim is the Chief Executive Officer of GIC. GIC is a global long-term investor managing Singapore's foreign reserves to secure the country's financial future. David Neal is Chief Executive of IFM Investors. IFM is an Australian global funds manager focused on long-term and sustainable investment commitments. Prior to joining IFM this year, David Neal was the Chief Executive Officer of the Future Fund. And Lei Zhang is the founder and CEO of Hill House Capital Management. Hill House Capital, founded in 2005, is an investment platform that partners with visionary entrepreneurs to build businesses and position them for long-term success. Chow Kat, David, and Lei also serve on FCLT's board of directors, and CPP Investments has been involved since the beginning. And you will notice that all of their biographies include the word long-term. We didn't add that. That was already there. So they're all very much focused on long-term investing, and we appreciate that. So I'm going to ask one question to each of the panelists, and then we'll come back and ask a second one. We'll try to make this interactive as we can, so you all can ask each other questions if you like as well. So Soo-Yi, I'm going to start with you if I could. We have been considering how investors can provide advice to executives managing businesses through these challenging times. We've thought about it a little bit based on the old Maslow's hierarchy of needs, where liquidity and survival of the company are really the foundation, followed by employees, customers, suppliers, and then long-term shareholders. And all of you, of course, are long-term shareholders. So what advice would you give to executives leading their businesses and managing the multiple stakeholders that they have to manage during this difficult time?
Thank you, Sarah. Thanks for having me this morning as well. Wow, the advice to the leaders. There are a lot of things that leaders need to think about now. You know, really, the COVID pandemic brought sudden and unprecedented challenges to all of us around the world. And then we're pounded with negative news every day, right? So research also shows that the fear and insecurity shuts down our long-term thinking and creativity. So that applies also to the companies as well as leaders too. So my first advice is to resist fear and seize the opportunity to come out of this crisis stronger. One of the examples that I can share over the last crisis is Starbucks. So during the financial crisis back in 2008, you may know that Starbucks faced crisis when the customers opted for cheaper coffee. So they were forced to close many stores which were loss-making. But what I want to bring up is that more importantly, over the crisis, Starbucks shifted their focus from bureaucracy to back to the customers. And they implemented new strategy that includes My Starbucks idea, based on technology, based on free thinking and community involvement. And then you may know that following the financial crisis, their profit grew 3 times, and their stock price went up more than 4 times as well. However, the optimism and the confidence, I would say, that should be combined with realism and preparedness. On that note, my second advice is to be prepared for the situation getting even worse and recovery taking even longer. Right? So when the COVID initially hit, I remember talking to our portfolio company executives and the investment target companies who were all predicting that their business would be back to normal by this summer. And we all now know that that will not be. And despite this unprecedented support from the central banks and the government around the world, we all know that the real economy is still very much struggling. And that we're seeing the speed of recovery slowing down after the initial pickup, whether it's in China, which has faced this ahead of other countries, or North America or Europe, right? And the recovery will be depending on how the virus behaves, the timing of the vaccine, and also the mandatory as well as voluntary social distancing measures as well. And all of these are still very, very uncertain. Internally, we think that the global economic activities will not be back to pre-COVID level until 2022. So long-term investors like us, we're expecting the companies and leaders to understand and prepare for these pandemic's effect on the business under various if and then scenarios. Lastly, I would suggest that build loyalty from your employees, customers, and suppliers. Employees are your key assets. Protect your employees' health and safety, take care of your employees, adapt to the needs of your employees. It can not only help a business ramp back up more quickly when the situation allows, but also create greater loyalty among your employees. For example, we internally have implemented a few HR measures to support our employees, such as we created special COVID days off. We added the well-being allowances for home office setups, as well as developing very thoughtful return to the office policies, taking into account all kinds of challenges our employees are facing, whether it's elderly care, childcare, homeschooling, you name it. Similarly, I suggest demonstrate compassion for your suppliers and customers. It not only fosters loyalty among them, but also ensure they too can quickly recover once the situation eases as well. A few examples, just 2 examples from our portfolio companies include a Hong Kong-based ICT company, Hong Kong Broadband Network. They have waived service fees and offering fees for the broadband to underprivileged families. And they got a great reception from the communities here. And also our Indian toll road and developer and operator, L&T IDPL, they distributed food to migrant workers when they were making their way back home from cities to countryside on their foot. So these are just some of the examples that you can do. I mean, there are many things, as I mentioned, that leaders can think about and need to think about. I will not list all of them, but I would urge leaders to think about these 3 points that I just mentioned. Thank you, Sarah.
Great. Thank you, Sue. That's really helpful, really helpful. And I think that it's to me, it's so interesting that, the sorts of advice you're giving today is so different than, if we'd asked you this question 6 or 9 months ago. It's really changed.
Absolutely, yes.
So Chao-Kat, let me turn to you. We all recognize that this is unlikely to be the last crisis, or potentially not even the last pandemic. Many institutions have built reserves of trust and culture over time that they're drawing down in this time. Clearly, some leaders have taken a long-term focus and some have not. How can investors and companies build that trust and leadership to be resilient in the next crisis? I understand we're not quite through this one, but to think about building for the next crisis, and how do we need to reshape our governance structures for sort of the new reality of the 21st century?
Thank you, Sarah. Well, first, great to be on this call with my fellow panelists and I guess meeting everybody virtually. Great questions, difficult one. If I could kind of pick up a few keywords in your questions, I think you have words like trust, leadership, resilient. These are indeed really important in times like this. And in fact, just to say, indeed, every 10 years or so, we run into one of these crises, right? It comes in different form, but it's a kind of a stress test of all of us. So in thinking about, what leaders can do, I guess, to be better prepared for the next crisis, I would say, maybe look closer at those few keywords. For example, trust. Trust has kind of two elements. First is competence, right? Ability to do things. Second is alignment of interest, right? That you look after my interests, right? So if you have these two elements, you get a lot of trust. And trust, of course, conveys the benefit of, being able to take bolder actions, right? If you have trust behind you, you're able to act decisively without having to kind of go through a long consultation, for example. But how do you get to that in the first place? So back to those two things. I think competence, of course, is a matter of what companies need to do or organizations need to do to build up their resources, their capabilities. But it's also a matter of practice, right? It's a matter of getting ready. I think I really like what Sui said about, being ready, being prepared. So as an example, right, something like pandemic or other forms which kind of dislocate your day-to-day operation is something actually one can kind of prepare for. You can do a business contingency exercise. So for example, we have been doing that for more than 25 years. Every year we would actually split the team, go somewhere else just to try out whether the computers work, whether the desk is functioning. I must say, for many years, people ask question, do we really have to do that, right? I mean, what are we preparing for? Frankly, we wouldn't know, right? It's something that we just imagine could kind of dislocate and results in you having to split the operation or go to another place. And we never expected kind of a pandemic to hit in 2020, but it comes very handy, right? When we need to activate it, we are there. And of course, with technology these days, it has been pretty smooth, I must say. So competence is one thread to build trust. The other is, of course, alignment of interest. That people need to know, you look after their interests. I think Sui touched on the point about employees, for example. You have to put their health and safety as the priority. You have to look after their well-being in times like this in particular. There, I would say, and you mentioned, 21st century, whether we have to have a new kind of governance structure. I would very much like to kind of emphasize this idea of stakeholder. I think in the past, the concept was more shareholder, right, for companies. As we know, many organizations now around the world have recognized that it really goes beyond that. You have to take stakeholders into account. So the governance structure need to be updated accordingly, whether it's ESG, or other ways, how you treat your employees, and as Sui said, your suppliers, your business partners, all those things have to be aligned in terms of looking after their interests as well. So if you have the ability to demonstrate competence and demonstrating that you look after the interests of all the people that you do business with or you have impact on, I think you get that high level of trust, which would then allow you to actually do bolder things, right? Which leads to leadership. Because leadership, as somebody said, right, is making something happen that otherwise would not have, right? So, but in order to do that, right, you need to have the trust of the stakeholders so that you can act on it. So I think during this pandemic, we have seen, quite a lot of examples of how companies are able to do so. Really, those companies which have spent years building trust, right? It is not something you can kind of build overnight, but if you have that, you should use it, right? In times like this. So that's the concept that, I would highly advocate, kind of adopting. And on the point about resilient, I mean, resilient is about being able to recover quickly. There, I think the pandemic teaches us that it's not just being able to recover on your own. The individual resilient is insufficient. You really need collective resilience, right? As an example, the closing of the borders. The closing of the borders is very bad for businesses, right? Because a lot of businesses are global in nature. Closing of the borders are terrible for economy, for jobs, right? For investors. We can meet virtually, but it's not as good, right? So, and we are drawing down, as you said, our social capital, right? That actually at some point we have to find a way to build it back up. But this closing of border is necessary, right? Because you don't want the spread of the disease, to continue. But yet, as long as I guess some countries are not able to have that under control, I think we are then looking at a state of very, prolonged period of border being closed, and that's not good, right? So resilience requires, not to have weak links, right? So we really need to have a collective kind of way of being able to deal with that. So I think these are the few ideas which I thought, if every organization can kind of internalize, think about how they can, sort of live up to that collectively, I think we will have a lot of resilience coming out of this crisis. Thank you.
That's really helpful. One of the things we've thought about as focusing capital in the long term is what are the levers that drive long-term value? And one of the ones we've thought a lot about is incentives, but I like the way you put it, of alignment of interest, which is a little broader than that. And that is such a critical part of trust, as well as actually being competent. And obviously we see a variety of competence around the world in managing this thing, I will say, as an American. Lei, let me move on to you. Investment opportunities and risks are being reevaluated in both the near and long term, and this crisis has accelerated many trends that were already underway and reversed some others. The future of cities, transportation, the way real estate is configured, hospitality, e-commerce, robotics are just some of the areas that have serious long-term changes underway. So what are areas of particular interest for you in terms of investing that are both exciting to invest in this stage of this pandemic, and that you see as being resilient in the long term, given all of the issues that we are facing?
Yeah, absolutely. Thank you for having me here with a great group of panelists. And I would very much start by a dumbbell sort of idea. On one side of the dumbbell, you do have those innovative companies from robotics to artificial intelligence to online, conferencing, all those technologies that really have been growing very fast, but really COVID, hasn't changed much in terms of directions, but just accelerated. That has been the changes that have been happening. I think that's where seeing this part of the group still accelerating the development of the technology. But on the other side, I actually see equally even more exciting opportunities of investing in the traditional businesses, in the businesses that could embrace technology, that actually has been a victim in some way of the creative disruption of technology and been left behind, now could actually leverage technology to catch up. And I wanted to really come back to what Sui talked about the trust and Choki talked about the stakeholders. I think as an investor at large, all our stakeholders, the company stakeholders are your employees, your customers, but an investor at large, all your stakeholders is a society. And the whole, all the people that we work and live and interact with together. And I think finding a way to have people leverage technology to catch up with that, making technology more than a creative disruptor, but also a kind of an equalizer that helping people to do better. I think that's also could be equally exciting and making profit from long-term oriented shareholders. I'll give you an example. One of them is Bell, the women footwear company that actually has been suffering a lot during the COVID, as you can imagine. Everybody doing Zoom and virtual conference, wearing pajama, who would need dress shoes? And so in the months of February, March, the sales have been down more than 90% during the China's shutdown in the pandemic. But today, let me report to you that our sales now growing double digits. And indeed, what happened was the company, since more than 3 years of our ownership, we have leveraged technology to transform the companies from their design model to be just in time, to be the cloud-based inventory, quickly shorten the inventory time. So that means that when the pandemic's over, now we are in spring collection, and the Bell was the first one coming out of all the new spring collection because we didn't have much inventory for the winter, and we were able to move on much faster, more than 90%. But the WeChat-based employee mini stores grew a lot, and all those mini programs grew a lot. And each employee themselves have the chance to open their own stores and benefit from managing their own members, if you will. So I think another example I would give is Coolwell, a drugstore, offline drugstore company that we own, we control. That as you think that people are not going to the hospital or even the drugstores, that we have the online membership model. And even during our during the pandemic, we offer some help by giving away masks. The way we did it was a online lottery system, so that we could get all those members' ability to get a mask much faster and deliver to them, and taking turns and for them to go to their community stores as well. So I think that kind of help by leveraging technology, and also not only make the customers, the members, the society better, but also making all the employees. And you think about Bell. Bell has 120,000 employees. That's you're impacting almost 300 to 500,000 people in terms of families. That a lot of people thought that business could go under because of the threat of e-commerce and like other retailers. But we ended up going out of this crisis much stronger, both financially and employee morale and confidence. One more thing I wanted to add. So Chalky raised a very interesting point about the alignment of interest. I think I wanted to add a little bit here that because as a private equity investor, yes, we want to be a good stakeholder, but people sometimes say, you know what, but I also have to report to my LPs. I have my annual P&L I have to report. I have cash flow. I have so much financial leverage I need to deal with. So the way I think about this is that really the only thing that matters is the duration. So if you think about the next quarter or next year or next 3 years duration, of course you win. But if you think about it in terms of 5 year, 7 year, 10 year, 20 year duration, that you do much better job of aligning yourself. So there's much less conflict when you are able to think for the long term. I think it's for the same results, for the same action. When you are aligned for the long term versus aligned for the short term, you just got totally different results for that. So I would add for showcase alignment and interest with that long term sort of orientation that even though short term people might be aligned for financial performance, but for the long term people make that much healthier, sustainable results for everybody.
Great, thank you. I think we've lost a little of your picture, but we hear your voice, so that's what matters. Well, I will admit I'm not wearing pajamas, but I haven't put on high-heeled shoes in a long time, so I may be maybe in that same boat. So David, let me turn to you. So we've talked a lot about the pandemic and the impact that's had. One of the other issues that we've been thinking about, of course, is climate change. And so while this pandemic had a fairly short lead time, we're well forewarned about climate change. And there are many critical aspects of the climate issue, but of particular concern right now is how do we rebuild the economy with a lower carbon footprint and greater resilience to future climate disruption. So I know you all have been thinking about that a lot in Australia, and I've heard this phrase, building back better. So how are you building back better in Australia?
Thanks, Sarah, and hi to everybody, and thanks for having me here. And it's great that you're asking about climate change. I think there's a bit of a danger with the immediate challenges in front of us of COVID. They're so sort of front and center that we could lose sight of some of the other long-term risks and issues that do impact us all. And we clearly can't afford to do that. And climate change is arguably chief amongst those influences, those very long-term, very impactful influences. So, we think it's pretty crystal clear that we've got to understand the impact of climate change and what that impact will be on our investments and the economy. So this point about resilience of the economy is key. I think the point about building back better is it seems to us that indirectly building that we can support the transition to a low carbon future that helps with that resilience against future climate change, whilst at the same time helping actually to offset the terrible health and sort of economic hardship that we're all struggling with under COVID. There's an opportunity here for us as long-term investors to deploy capital that builds new long-term assets, that builds assets onto existing assets that we might have in our portfolio. But through that build process, generates jobs and economic recovery now, which is surely needed, delivers the robust investment returns that we all need for our retirement members around the world, but at the same time is building assets that do deliver that kind of resiliency against climate change in the future. So, we should be looking at, and we're exploring a number of opportunities across infrastructure, debt, equity. We should be looking at these sort of decarbonisation type opportunities. Now is surely the time to be building those assets that the economy and the world needs. So some of those, as I said, there will be new investments that we're looking at what some of those might be, greenfield type investments. I think the easiest, really, and no less powerful opportunities, though, are across existing assets. We've got a large pool of assets around the world, and there's all sorts of things you can do to lower the carbon emissions across those assets. We've got plans. We're building plans for those assets to get their operations to net zero emissions as quickly as we can. And so things like at Melbourne Airport, building solar farms. These are assets with lots of space, lots of land. We have plenty of sun here, even in Melbourne. And so we can, the idea of delivering renewable energy to power the passenger terminals kind of makes sense. And now has to be the time to be making these types of investments at exactly the time when the economy needs this injection of kind of capital. So those are the sorts of things we're thinking about, and this obviously isn't just an Australian thing. We're looking at similar proposals for our assets around the world, and this is what we'd be encouraging others to do. I also wanted to, I think there's another way that we can build resilience to focus on long-term risks from climate change across all of our investment portfolios. It's clear that physical and transition risks are very real, and so I think we all need to be looking really hard at those risks, creating detailed assessments of those risks, and understanding what actions we need to be taking. And again, this is a good time to be doing that, because deploying new investment to help resolve those risks will help us with the recovery. I think there's often a concern that a lot of this risk assessment work is really kind of fuzzy and uncertain and difficult and challenging, and we don't have the data and it's all too complex. It is really difficult, but if we don't, that doesn't mean we can afford to be in the dark and afford to ignore it. I think we've got to get on with those risk assessments. We've got to do the best job that we can, and the more we do it, the better we'll get. And so again, we'll be able to allocate capital more efficiently. One of the things that takes me to, I just wanted to comment finally on another tool that helps us build resilience in this area is the disclosure. And I did just want to advocate for the Task Force for Climate Related Financial Disclosures, TCFD. At IFM, we support the TCFD, and we're committed to full disclosure and alignment with their recommendations. And I really would encourage other companies and investment managers to do the same. But if we have better disclosure, more widespread disclosure, then again, investors can better understand and price risks. Our financial system becomes more efficient. The businesses themselves can make better, longer-term decisions about allocating their capital, and all of this comes together to improve resilience. So, I've strayed a little bit beyond the building back better right now, but I think this concept of helping us be resilient to climate change as a long-term capital allocation problem is so important. And if we get on with it now, then the allocation of that capital can really help us get through the challenges that we're under. So those are my thoughts, Sarah. But I'm very interested in any Q&A.
Yeah, well, that's really helpful. And I think that, I think, Sue, you started off with sort of how do you think long term when you've got all these short term things in front of us. And David, that's an example of, sort of trying to turn that, inside out, which to say this is the time to do that.
Yeah.
Interesting. So Suyi, let me come back to you. I'll make shorter questions, and we'll get through them, and then we'll see what other questions we've got coming in, and Lay's coming in and out. So I'm going to go to Suyi, and then I'll come back to Lay. So we've talked a lot about, and Lay mentioned this as well, sort of the barbell of you've got new companies, robotics and AI and those sorts of things, as well as retooling, old companies. And David, you mentioned the opportunity to retool old assets as well. And so Suyi, Asia's been riding this wave of homegrown innovation with breakthroughs in robotics and AI and drugs and mobile payments and so on. But, as always with technological change, there is this creative destruction, there is disruption, there are these sorts of things. So how do you think about investing in the technologies of the future in Asia? Do you have more of the venture capital startup mindset with where you have many failures and a few successes? Or are you more interested in thinking about the other side of the barbell, as Lay said, of sort of reinvesting in established players and taking them to the next level? How do you think about that investment choice?
Mm-hmm. Thanks, Sarah. So in Asia, we've been investing in this new economy for over the last decade, since we invested in Alibaba. So as you alluded, Sarah, evaluating innovative technology company is not easy. So I remember that when we invested in Baba, we were still able to use the traditional metrics of evaluating businesses, whether that's an EBITDA multiple or P multiple, because Alibaba was making good profit at that time already. But after Alibaba opportunity, the other opportunities that we saw in Asia, China coming out were different. I remember talking about Meituan back in 2014 and 15. And that was actually, in fact, our first private equity investment into companies that did not have any profit. Right? So I remember talking in the investment committee for a long time, debating on, can we really use this revenue multiple to evaluate businesses? But I'm glad that we invested in it. We all know how well the company has done. I would say that our investment thesis on all of these businesses in Asia, at least, has been really underpinned by our belief in Asian consumers. And then that got us over the line, whether it's established company investments or early stage company investments. When we're putting the lens of the consumer in Asia, the growing middle class, urbanization, essentially a pickup in consumption in China behind it, then you can make sense out of it a bit better. And of course, these amazing technology companies in Asia, and particularly in China, and their strong performance, really eye-popping performance that we have seen for the last decade, supported our continued investments in that sector. And that also helped us to learn by making that investment, how we need to evaluate and then what is possible in the markets like China, where their home market is very large. So our investment team has been continuously studying in various sectors, not only the e-commerce where we started, but the payment, healthcare, and the education, to really understand long-term structural changes that's coming in this part of the world and around the world. And we've been able to express that through investments like Ping An Good Doctors, which has been doing really well over this pandemic, or Ant Financials, which is now going through the IPO as well, and Baiju, which is an education company in India. It's an online education company. And then we have also recently launched the venture capital strategy. I know that GIC had that program for a long time, but it's relatively new for us in San Francisco to make fund and co-investments. And through that, we could have a bit more earlier stage exposure as well. So we're going to continue to invest in both more established companies indirectly, as well as investing through the funds and the earlier stages through these venture capital funds too. And I will continue to do the deep research and learn from these portfolio companies. So that's our approach.
Great, thank you. So David, let me come to you as we think about, how we're investing. So we talked about climate change before, but in many countries, accelerated or expanded infrastructure spending is part of the recovery plan. And obviously there's a lot of public expenditure in that. But how can you talk a little bit about the role of long-term investors, private investors who are managing either existing or greenfield infrastructure, and the role of private investors in trying to get that up and running. So do you think private investors should play a bigger role in greenfield infrastructure as the recovery takes shape? And if so, how do you go about that sort of private greenfield investment?
Yeah, thanks, Sarah. I mean, should they play a bigger role? I think the answer to that is yes, and probably always has been. I think right now there's almost not a lot of choice. There's, you know, the governments around the world of various types are obviously severely stretched right now from a fiscal perspective, and so you know, they really must be looking at how to tap into private capital. But I think the key is not just is it private capital or not. The key for us is how private capital is deployed to create the most effective long-term outcome. One of the challenges that we've been wrestling with here in Australia is the most common procurement model for new infrastructure build, for greenfield infrastructure, is the PPP model, and it's been targeted at. It tends to work best for large contractor-led type proposals, highly levered vehicles, skinny equity layer. That gets the cheapest price for the government. But what it also gets is very little focus on the long-term success of the asset, because the contractor is focused on a construction margin over a 3 to 4 year period. And when something goes awry, you've got a very skinny equity layer to absorb any of that risk. And these large, complex projects, it's tough to know exactly what's under the ground when you're building that tunnel, or you know exactly what's in that soil. Is it you know, something toxic that needs cleaning up or whatever? You know, these risks arise, and you need, I think, a larger equity layer and a more aligned long-term partner to help assess these risks and absorb these risks than is currently the case. So, you know, a long-term owner can take that risk and spread it over 30 or 40 years of cash flows, and it still makes sense for them. So we're kind of talking to governments about how can we better involve long-term patient capital in these sorts of projects. It requires a different mindset, I think, from government. It requires them to think more about partnering with long-term capital than trying to offload all the risk day one to someone. Yeah, that just doesn't work. You try and offload all the risk if the government tries to offload all the risk, you know, if that project goes bust, the risk can only go back to one place, and usually with a lot of reputational issue along the way. So that's the sort of stuff we've been thinking about. There are lots of models around the world. As I understand it, CDPQ has been doing a great piece of work with the government there, building, I think it was light rail. But there are examples of where greenfield assets have been able to be built with a good partnership between government and long-term private capital, and we're trying to promote that.
It comes back to Chow Cat's point on alignment of interest before, right?
Absolutely.
Trying to bring that together. All right, well, Chow Cat, let me come to you then. Obviously, we're in a very low interest rate environment globally, but at the same time, government borrowing has risen quite dramatically, and social support expectations have risen around the world. So, how do you think about the short-term cure of this crisis coming back to bite us in the long run?
Thanks, Sarah. Well, indeed, in the last couple of months, I guess in response to the pandemic impact, governments around the world, central banks around the world have rolled out, right, large measures of fiscal and monetary support. I mean, if you look at just even the fiscal side, right, 10, even 20% of GDP size of spending is not uncommon. I mean, for countries which can afford it, you know, like Singapore actually, that we draw down reserves to do so, or for countries which, you know, has the ability to borrow, that has been the case. I would say actually has been quite necessary, right, to be able to make sure that the economy doesn't just kind of collapse. You need to breach that income gap that has been deprived, you know, of companies as well as workers. This long-term kind of trend of interest rate, in fact, you know, has been going on for a long time, right, in terms of decline. If you sort of take a step back, look at the long-term history of interest rate, it's quite amazing to see how interest rate has been declining since the early 80s, right? In the 70s, we have a pop, partly because of inflation and some of the fiscal policy, but we have since enjoyed this, you know, decline of interest rate, right? Which has been a very, very, in fact, the most, I would say the most important tailwind of financial markets in the last 40 years. So going ahead, I think at this level of interest rate, I have some concerns, specifically three. The first is that it sort of distorts some economic decisions, right? That if it is, you know, something that actually normally doesn't qualify in terms of using leverage or having the capital, it goes ahead now, right? Because interest rates are just so low, and in some places even negative. So that's the first. The second is the fragility, you know, in the fact that more debts are being injected into the system, whether it's public or private, right? I think one clear legacy of this pandemic is that the debt level globally for both public and private sector will be higher. So that itself creates some higher level of fragility. And the third is the financial market itself, right? Has been encouraged and supported by low interest rate. And if you look at the valuation matrix of a lot of companies, that's a big driver. So that again, you know, that concentration in terms of the driver of price increase creates another fragility. So these are the three. The government has to, it's a real test of policy making, right? How do you get the economy going, protect the supply side infrastructure, and also hold up the demand with innovate. I would say there needs to be more innovation in terms of how do you get the dollars into productive uses, right? While we understand that in the short term, we have to breach this income loss, it's certainly not a long-term solution. I think what David talked about in terms of getting the dollars into, say, infrastructure, which can produce long-term economic return, I think those are the kind of actions that I hope to see more from the policy makers, rather than just kind of, you know, hold up the financial markets and hope that there's spillover into, you know, sort of household wealth, and from there you get aggregate demand. That itself is not sufficient. That itself actually creates some of the fragilities that I mentioned.
Great. All right, Lei, I think we've got you. I'm going to come back to you, and I hope your technology is good. And if not, we've got a bunch of audience questions too. So, Lei, are you there? Can you hear me okay?
Yeah, I hear you.
Okay, we're getting a little echo from you now. You're sort of coming in at, well, I'm going to ask you the question and we're going to see if you can answer it. And if not, we can ask you more offline. But the question really was about never letting a crisis go to waste. So, you know, as we look forward, what crises do you think we should be preparing for? And and what kind of actions do you think we individually can take, and we would like others up and down the investment value chain to take to support sustainable capitalism as we come out of this crisis? Let's see if we've got audio to hear your thoughts on that one, Lei. Sounds like we've lost him. Okay, well, why don't we do this then, and maybe he'll come back in. Hopefully we'll come back in. We've gotten a bunch of interesting questions. And so I'm gonna throw out 3 questions at once. We only have 5 minutes, and I'll let each of you, if there's one of those that you want to, we'll stick with the one question that we tried to ask Lei, which is, what are things that we can do to support sustainable capitalism coming out? But the 3 that we've gotten in particular, one was about the Chinese green bond market, which is green bonds have grown significantly. China is one of the largest issuers, and but there's a lot of skepticism about are they really green? And so how do we think about growing the Chinese green bond market? Some of these we may have to follow up with. The second was, there was a interesting question about there's a lot of common ground for Canada, Australia, the US, and China to work together on sustainability or climate change. And so leaving aside the policy differences, are there ways that we could foster long-term business cooperation among those countries in a way that is beneficial for the climate? And then the third is, are there any comments on the US-Chinese tensions, and particularly the way that it might affect technology investing going forward? All right, so we have 5 minutes, and we've got 3 really big questions. We don't have to answer any of them in any particular order. But Suyi, maybe I could let you give a thought on any one of those questions that you might like to answer as sort of a quick lightning round.
Yeah. I mean, green bond is one of the things that we've been using internally to raise capital as well. We're actually leveraged, our overall fund is leveraged as well. And our infrastructure investments and other equity investments, we've been making investments into the way that it's in a climate change conscious and an environmentally conscious way. And then we've been able to issue the green bond in the past, but we haven't looked into the China market. So no comment there. On the political tensions that we're seeing, geopolitical issues, I would say that is not only about technology investment in China, but it applies to a lot of investments globally. And then someone mentioned that political risk in the past wasn't key part of the diligence for the investors, but now that squarely became part of the discussions for every single investment. And I would say that applies again for whether you're investing into the Europe or investing into Canada or in the US, of course, whether you're investing in China, it became part of the investment discussions because these policy changes could make impact to the companies, whether it's a short term or medium term.
Great. David, do you want to comment on any of those questions?
I don't know a lot about the Chinese green bond market, so I might leave that for others. But I think probably the main comment I could make is on sort of fostering cooperation across countries. I'll leave the political cooperation to the governments, but long-term investors play a really important role here. I think we run there's a couple of big global asset owners on here, and there's a couple of global asset managers and 2 global asset owners, all running global portfolios, all likely working with each other on different assets, co-invested. That ability to take insight and knowledge and understanding from one jurisdiction and one asset and deliver it into another is, I think, one of the great advantages of these sort of global platforms that big investors have. So across our space at IFM, in particular the infrastructure space, we see that happen all the time, and I think it's a really helpful and healthy part of the industry.
And Chao Kat, last word from you then. Any of those questions or any others?
No, quick comments on sustainability. Very much. I guess shared a similar views with Sui and David. TCFD, we are also a signatory. Indeed, very important, right, to get the data. But there's no magic bullet, right? You have to do a whole range of things. And I really echo what David said about having, all these collaborations, dialogues, in many forums, trying to tackle different issues. Goes back, I guess, to my point about having collective resilience, right? It has to be collective. I mean, it's a global problem. So no single party can solve the problem, right? So it does really require not just different countries, but different kinds of stakeholders, right? Investors, of course, part of that, companies, part of that, and a whole bunch of tools that we have to embrace. So that's on sustainability. On the other question about this geopolitical tensions and fragmentation and things like that is a real challenge for investors to be able to navigate this. As Sui said, everything that you looked at is not just between China and the US, but many other spheres as well. You have to consider, right, what is the implication of that. I would say any setback, I might say, to the free flow of capital is a challenge, but the world is pretty big, right? That for investing people, one sort of metrics we always looked at is your TAM, right? Your total addressable market. If you look at that, for a lot of companies, even if you are confined to a particular region, it's still pretty big. There's still a lot of room, and they still have a lot of competition, even if they are confined to that region. So to that extent, it's a big challenge, but I think we all know how to sort of deal with and cope with it.
Well,
so
just
a quick comment on the cooperation. It occurs to me that that an entity that brings together asset owners, asset managers, and corporations to all focus their capital on the long term sounds like a great idea, and that people should join that as a business cooperation idea. What do you think?
I think it's a great idea, David, and I couldn't have said it better myself. So thank you. Thank you for that. And thank you all for being our panelists today, and thank you all to the attendees who've joined us. You've given us a lot to think about. We will take this and try to put it into a format that's shareable and digestible, and hopefully not lose some of the richness of this conversation. So really appreciate all of your contributions to focusing capital on the long term, and very much appreciate this perspective on how we can keep this long-term multi-stakeholder perspective in a very challenging environment. So thank you all very much.